The AI gold rush is real, but buying any data center stock is a fast way to get burned. In this video, we'll break down Singapore's key data center REITs, expose the hidden risks the headlines miss, and give clear buy, hold, or sell calls so investors can act with conviction. What you'll get today is a focused, Singapore-first deep dive adapted from my latest in-depth Substack post. You'll see which REITs deserve a core allocation, which are yield traps, and how to map them to CPF or SRS use cases. We'll go section by section, mirroring the article's flow and include highlights from every key table. I'm Iggy from the Investing Iguana, Singapore-based market analyst and content creator. My goal is to turn complex finance into clear steps fit for the local investor. If this helps, hit like, share it with a friend, and subscribe for more Singapore-focused breakdowns. First, let's talk about the new digital gold, why data centers are booming. Data centers are the backbone of digital life. Every stream, cloud app, and AI task runs through them. Demand is surging from three fronts. One, AI models need heavy compute and storage, pointing straight to more racks, more power, and denser facilities. Two, the cloud migration continues as firms shift workloads from on-premise to hyperscalers. Three, Singapore's policy shift matters. The earlier moratorium capped new builds due to sustainability. New green rules now allow more growth, but supply remains tight. This gives landlords real pricing power, so rental reversions for some assets are massive. For investors, that means the theme is both strong and durable, but not all REITs capture that growth equally well. With that context, let's compare the main players in Singapore. In the Substack, you saw a simple table comparing valuation, yield, leverage, and recent returns for Keppel DC REIT, Mapletree Industrial Trust, Digital Core REIT, and Ascendas REIT. Here's the summary. As of early September 2025, Keppel DC trades around 1.5 times price to book with a yield near 4.4% and low gearing at 30%. Mapletree Industrial Trust is closer to 1.1 times book with a yield near 6.3% and gearing a bit above 40. Digital Core is the outlier with a very low 0.66 times book, a high yield about 7.9% and gearing in the high 30s. Ascendas is near 1.2 times book, yield around 5.5%, and similar gearing. The big takeaway is that quality commands a premium, weak track records carry a discount, and leverage differences matter when rates move. So if two REITs both hold data centers, but one is growing DPU and managing lower debt, should they trade at the same multiple? Probably not. Let's dig into each name. Keppel DC REIT is the pure play leader. The table in the article called out three things. DPU growth in 1H 2025 was 12.8% year on year. Gearing sits around 30%. And rental reversions cleared 50% on a major renewal. That says a lot. Strong demand, tight supply, and solid execution. Lower leverage gives room to grow without stress, which matters as rates stay sticky. DPU growth at 12.8% shows the REIT is delivering for unit holders. Gearing near 30% shows prudence, and rental reversion above 50% proves pricing power in a constrained market. There are risks, of course. Quality comes at a price. So the higher price to book means you pay for safety and growth. But leadership deserves a premium, especially when CPF or SRS allocations need both stability and growth. The verdict: buy. For long-term Singapore investors keen on a focused data center play, Keppel DC remains the anchor choice. Ask yourself, is your CPF allocation safer in a pure specialist or a generalist with mixed assets? From the pure play champion, let's move to the diversified workhorse. Mapletree Industrial Trust, or MIT, has pivoted hard into data centers. The article's table showed the split, about 55.6% in data centers by asset value. The rest in high-tech buildings, flatted factories, business parks, and stack-up properties. That blend brings resilience but dilutes the pure data center upside. U.S. exposure caused vacancy headwinds, a risk flagged by analysts. Still, yield around the mid-sixes and a strong sponsor help. The key here, over half MIT's portfolio is in data centers, about a fifth in high-tech, and the rest in legacy industrial formats. This isn't a pure play. The upside is income stability. The downside: blunted AI-driven growth. Major risk: U.S. vacancies and slower growth from other segments. Verdict: hold. If you already own MIT for the income and diversification, it's reasonable to keep it. But if your aim is a sharper bet on data center growth, MIT won't cut it. For an AI sector theme, does mixing old and new properties meet the objective or dull your exposure? Now, onto the high yield, swing for the fences name. Digital Core REIT has a rough 3-year record. The table highlighted its very low price to book, very high forward yield, and deeply negative total return. It's a turnaround play. The market demands a fat yield to own the risk, and execution must improve, showing up in occupancy and DPU. Here's the visual summary. 3-year total return is bruised, valuation is at a deep discount, and yield tempts. Question is, has the risk fully cleared, or does the discount show ongoing danger? Risk of capital loss and volatility is real. The article's verdict is nuanced. Speculative buy only for experienced investors. Tiny position, strict limits. Otherwise, avoid, especially for CPF or SRS, where capital stability trumps everything. If a REIT offers 8% but can't protect your capital, is it yield or a trap? Turnarounds can work, but they aren't for everyone. Now, from high beta to the steady giant dabbling in data. Ascendas REIT is a top industrial REIT with some data centers, but these form only a small slice, single digits by portfolio value. The article made it clear. If you buy Ascendas for data center exposure, you're picking the wrong vehicle. Quality? Sure. Focused data center play? No. The verdict? Avoid if you want data center growth. If you want broad industrial exposure with scale, by all means consider it. But for an AI-driven theme, Ascendas doesn't fit. If you needed to catch a plane, would you buy a bus ticket? Next, the new listing set to shift the landscape. NTT DC REIT debuted in July 2025, backed by NTT and GIC. Initial footprint: 6 data centers in the US, Austria, and Singapore. Northern Virginia, Vienna, and Singapore are all key strategic locations. The sponsor's global pipeline matters, but any new REIT must prove itself. Consistent DPU growth, capital discipline, and integration. The table shows a global spread with hyperscale and colocation. For now, the move is to watch and wait. Add it to your watch list if you want proof before putting money down. For all the full tables, charts, and details in writing, check out the Substack article, link in the description below. Let's tie it all up with actionable takeaways. Build around quality. Keppel DC is the leading candidate for a core allocation for most, thanks to its growth, balance sheet, and execution. That makes it CPF or SRS friendly. Avoid yield traps. Digital Core might dangle high income, but unless you're a seasoned investor who knows how to manage turnaround risks, don't reach for yield only. Know what you own. MIT and Ascendas offer diversification benefits, but are not pure data center bets. Focus on the long game. The real money will come from compounding DPU growth and stable management over many years. My personal take: in a Singapore portfolio, match your vehicle to your objective. If you want a focused AI or data center play, Keppel DC is the anchor. For blended industrial income, MIT is fine to hold. Broad stability and scale, Ascendas works, just not for this particular tech-driven story. Digital Core is a tactical position for advanced investors only. It isn't a retirement pillar. CPF and SRS sleeves should favor steady DPU growth, modest leverage, and proven pricing power. Watch rates, watch sector supply, and keep an eye out for policy and grid stories as AI workloads grow. What matters more for retirement? Today's pretty yield or steady DPU growth with low risk for 10 years out? The recap: data centers matter. The big 4 Singapore REITs are not created equal, and quality shines through in numbers, management, and resilience. Keppel DC is the buy, MIT is hold, Digital Core is a speculative buy or avoid, Ascendas is avoid for this theme, and NTT DC REIT is on the watch list. These principles will help you build a resilient, income-growing Singapore portfolio, setting you up to benefit from the real digital gold rush. If this helped, please like, comment with your most interesting takeaway or burning REIT question, and subscribe to the Investing Iguana for more. Want the full written deep dive, model tables, and special member content? Join us on Substack. Free tier gets alerts. Paid members get comprehensive analysis and exclusive Q&A. Link in the video description. And if you want to align your REIT actions with interest rate trends, watch REIT Interest Rates Playbook, how to position for a rate cut cycle, right after this.